Welcome to the Deep Dive. Today, we're taking a close look at the global and Indian economies, focusing on where things stood around March 2025.
Hmm.
We've pulled together data from quite a few sources, Rakshitra, CCIL, Bloomberg, the IMF, lots of others.
Right.
And the goal really is to kind of sift through it all and give you a clear, insightful picture of the macroeconomic landscape right now.
Exactly. It's about more than just the raw numbers. We want to understand the story they're telling,
Mhm.
about the health and the direction of things globally, and especially here in India.
Okay, great. So let's dive in. Maybe start with that big picture view of global growth. The OECD projections, they really put India right in the spotlight, don't they?
They absolutely do. For 2025 and 2026, India is pegged as the fastest growing large economy.
Yeah, looking at what, 6.4% in 25 and maybe 6.6% in 26.
That's the projection, and it's quite striking when you compare it.
So what's driving that? Is it strong domestic demand mainly, or government policies, or, a mix?
It's likely a combination of factors. India's large domestic market is certainly a huge internal engine.
Hmm.
Plus, you've got government efforts focusing on infrastructure, manufacturing. That's all playing a part.
Right. And the contrast you mentioned.
Well, look at China, projected growth around 4.8%, then 4.4%. The U.S., 2.1%, then 1.6%.
And the euro area even lower?
Yeah, 0.8% and 1.2%. It really does underscore India's sort of dynamism right now. Makes it stand out for global investment.
It certainly seems that way. And just briefly, on the other side, Argentina's facing negative growth.
Yes, minus 1.3% and minus 0.6% projected for 25 and 26. Highlights the very different challenges countries are facing.
Okay, so shifting slightly recession risk. This is where India looks, well, remarkably stable.
Absolutely. As of mid-March 2025, the probability of recession in India in the next year was 0%.
Zero. That's pretty incredible compared to, say, Europe. Germany's around 50%, France over 50%.
Right, 53% for France.
Could that difference be down to India being maybe less reliant on certain vulnerable global sectors than Germany, for instance?
That's a very good point. India's domestic demand cushion is significant. Plus, its trade structure is different compared to some highly export-oriented European economies.
Makes sense. Prudent policy probably helps too.
Fiscal and monetary policy definitely play a role in that stability, yes.
Okay, so let's look at a more real-time indicator, economic activity. The composite PMI, the one from market.
The Purchasing Managers Index.
Right, and the simple rule is above 50 means expansion, below 50, contraction.
And India's reading for February 2025.
A very strong 60.6. That really backs up those growth projections, doesn't it?
It does. A reading above 60 indicates a really robust expansion across both manufacturing and services, suggests healthy order books, rising production.
A positive outlook overall.
Exactly. And again, the contrast is clear. The euro area was just below 50.
49.2, indicating slight contraction maybe?
Potentially, yes. Japan, the US, the UK, they were all hovering just above 50. So much slower expansion.
And Brazil actually below 50.
Right, suggesting a contraction there. So India's activity level really stood out.
Okay, strong position then. Let's talk government debt now. We're looking at the expected change in gross government debt relative to GDP between 2019 and 2025. What jumps out?
The big story here is the split between advanced and emerging economies.
How so?
Well, you see pretty substantial projected increases in government debt for many advanced economies. The UK, for example, is looking at an 18.2 percentage point rise.
Wow, France.
France, 17.6 points. The US, 16.1 points. Big jumps.
Okay, and compared to emerging economies.
Much more moderate increases expected. India around 4.5 percentage points. Brazil about 4.9.
So suggesting a bit more maybe fiscal control or just different circumstances in those emerging markets.
It suggests perhaps a relatively more contained fiscal situation compared to the spending or borrowing needs seen in some developed nations post-pandemic and with other pressures.
Interesting. And related to global finance, where does India sit in terms of holding U.S. government bonds?
Well, the big players are Japan and China, holding over $1 trillion and around $760 billion respectively.
In India.
India ranks 14th. Its holdings are significant, around $225.7 billion as of that period.
Okay, so sizable, but puts things in perspective compared to the top holders.
Exactly. It reflects the relative scale and integration within the global financial system.
Got it. Let's shift now to world trade. There's been a subtle but important shift in its composition over time.
Looking back to 2005, merchandise, physical goods was about 80% of trade. Services 20%.
And fast forward to 2023.
Merchandise is still dominant at 76%, but services have crept up to 24%.
So services are playing a growing role. What does that mean for an economy like India?
It's potentially a big opportunity. Think tech, finance, business process outsourcing, areas where India is strong.
Right. So this global trend towards services could be beneficial.
Definitely. It aligns well with some of India's key strengths in the global marketplace, but it's also worth noting the growth rates.
Ah, yes, the TGR figures.
The long-term 30-year compound annual growth rate for merchandise trade was a pretty healthy 6.3%.
But more recently.
The 10-year CGR is much lower, just 2.4%.
That slowdown is significant. Reflects maybe supply chain shifts, protectionism, slower global growth.
Could be a mix of all those things. Something to keep an eye on, especially for economies reliant on goods exports.
Okay. Now, trade balances, surpluses, and deficits in merchandise trade for 2023. Who are the big players?
Well, China had by far the largest surplus, just massive $822.7 billion.
Wow. Anyone else close?
Germany was next, but way behind at $241.6 billion. Then others like Russia, Saudi Arabia.
And on the deficit side, the biggest importers relative to their exports?
The U.S. had the largest deficit, a huge minus $1,151.9 billion.
Over $1 trillion deficit.
Yeah. The U.K. also had a substantial deficit, around minus $270 billion.
In India.
India had a deficit too, minus $137.6 billion.
So China's surplus, it's really enormous compared to everyone else.
It really underscores its role as, the factory of the world.
Yeah.
Highlights those global trade imbalances. The big deficits in the U.S. and U.K. often point to strong domestic consumption pulling in imports.
Right. And looking specifically at the U.S. trade balance for 2024, they ran big deficits with China, of course, but also Mexico and India, too.
Yes, the U.S. deficit with India was around minus $49.5 billion in 2024.
Which naturally brings us to tariffs. The data shows the U.S. has different tariff levels with various countries, both tariffs it imposes and tariffs imposed on it. And interestingly, for India, there's a negative differential, meaning the average tariff India imposes on U.S. goods is somewhat higher than the average tariff the U.S. imposes on Indian goods.
That's right.
How might that play out in the trade relationship?
Well, theoretically, higher Indian tariffs could make U.S. goods less competitive in India. Lower U.S. tariffs could help Indian goods in the American market. These differentials are, often our focus in trade talks.
Okay. Let's quickly pivot to global market performance. For the quarter ending March 2025, how did things look?
It was actually a bit of a mixed bag, maybe even tilted negative for many major indices globally.
Really? Despite some positive economic signs we discussed?
Yeah, there was volatility. But interestingly, some markets did really well. Russia's index was up over 24%, Brazil over 11%.
That's counterintuitive maybe, given global uncertainties. What could be behind that?
Often driven by very specific local factors. Commodity prices could boost Brazil, for instance. Russia might have internal market dynamics at play despite sanctions. It shows markets don't move in lockstep.
And some were down significantly.
Yes, Taiwan and Japan saw double-digit negative returns for that quarter.
Okay, a varied picture.
Mhm.
And one last global point before we zoom into India, the PEG ratio.
Ah, yes, the price earnings to growth ratio.
Right. This looks beyond just the PE ratio, factoring in expected earnings growth. A lower PEG can suggest better value kind of growth at a reasonable price.
Exactly. Gives you a more nuanced view than just looking at current price multiples.
And the data as of Feb 2025 showed different PEG ratios across MSCI indices for India, China, the US, and others, provides a comparative snapshot for investors.
Precisely. A tool to compare potential investment value considering future growth.
Okay, great context. Now, let's really focus in on India's macro trends, building on that picture of, relative strength globally. GDP growth first. Looking at the annual real GDP growth from FY10 right through to the estimates for FY26, it's quite a journey.
It is. You see the fluctuations. You see that big dip in FY21, the minus 5.8% contraction due to the pandemic.
But then a strong recovery.
A very strong recovery. And the projections for FY25, the official estimate was around 6.5%.
And the RBI's estimate for FY26 is also 6.5%.
Right. So picture a fairly consistent strong growth expected. It really reinforces that fastest growing large economy tag.
What are the key domestic drivers keeping that momentum going?
Strong domestic consumption is still a bedrock. Government spending, particularly on infrastructure, is a major push. And then you have ongoing factors like demographics, urbanization.
A growing middle class.
Exactly. All feeding into that sustained activity.
Okay, now, inflation. The picture here seems a bit mixed. Headline CPI eased.
Yeah, down to a 7-month low in February 2025, 3.6%.
Yeah.
Mostly driven by lower food prices, it seems.
Which is good news. But core inflation.
That actually ticked up slightly to 4.1%. Core excludes food and fuel, so it gives a sense of underlying pressures.
But overall, inflation is still within the RBI's target band, right?
Yes, thankfully.
Yeah.
So headline easing is welcome, but that stickiness in core inflation means you can't declare victory just yet. There might still be demand pull or cost push factors at play underneath.
Needs monitoring then. Okay, let's look at core industries: coal, steel, electricity, etc. Their production growth.
Data for December 24 and January 25 showed some interesting movements. January, in particular, saw big jumps in coal production and petroleum products,
What does strength in coal and petroleum products suggest?
often linked to broader activity. More coal needed could mean higher power demand from industry. More petroleum products could mean more transport activity, distribution.
So potentially leading indicators for the wider economy.
They often are, yes. Good barometers of industrial and transport activity.
Now, drilling down into manufacturing specifically, using the Index of Industrial Production, January 2025 data.
It was a bit of a mixed picture within manufacturing itself.
Some winners, some losers.
Pretty much. You had really strong year-on-year growth in areas like electrical equipment, other transport equipment.
Okay.
But then other sectors like printing, leather products, they actually contracted.
So growth isn't uniform across the board. What could explain that variation?
Lots of potential reasons. Strong domestic demand or specific government schemes might be boosting electricals and transport. The contracting sectors might face weaker demand, import competition, or specific input cost issues.
Right. It's never just one simple story. Okay, turning to exports. How did India's merchandise exports look in February 2025 compared to the year before? Which sectors contributed most to growth or held it back?
The data shows positive contributions coming from electronic goods and rice.
Electronic goods, that's interesting.
It is. It suggests a move up the value chain, perhaps. On the other hand, petroleum products and engineering goods actually had a negative contribution to growth in that period.
So shifts in the export basket. The rise in electronics exports seems like a positive sign for diversification.
Absolutely. Reducing reliance on traditional exports and building strength in higher value areas like electronics is generally seen as a very positive development for long-term resilience. The dip in petroleum products could just be volatile global prices or demand shifts.
Okay. And lastly, on the macro front, currency and reserves. What happened in March 2025?
Well, the rupee actually strengthened against the US dollar by just over 2%.
Well, the dollar index itself weakened.
That's right, the DXY lost some ground. And alongside that, India's foreign exchange reserves kept climbing,
Reaching.
a very healthy $665 billion by the end of March 2025.
So a stronger rupee and rising reserves. Generally positive signs.
Generally, yes.
Right.
A stronger rupee can help moderate imported inflation, although it can make exports a bit pricier. The rising reserves are crucial. They provide a buffer against external shocks, boost investor confidence, really important for stability.
Okay, solid macro picture overall then. Let's switch now to India's equity markets. One trend highlighted is market cap concentration. The share of very large companies, those over 1 lakh crore market cap in the total NSE market cap, has been steadily increasing.
Yeah, it reached 81% by FY24 and seemed to be holding around there in early 2025.
So the giants are getting a bigger slice of the pie. What are the implications of that?
Well, it could mean less visibility or maybe tougher competition for smaller and mid-cap companies to attract investment. It can affect market breadth, but it also reflects the strength and perhaps perceived safety of those large established players.
Interesting dynamic. Another shift. Trading itself. Algorithmic trading. Algo versus non-algo.
Algo trading is really taken over in the cash market segment.
What percentage are we talking about?
By FY25, it was accounting for nearly 54% of the turnover, a clear majority.
What's driving that, and what does it mean for the market?
It's driven by technology, the quest for speed and efficiency in execution. It can definitely boost liquidity.
But downsides?
Potential for increased volatility sometimes. Maybe flash crashes if algorithms react unexpectedly or in unison.
Yeah.
It changes the market microstructure.
Okay. And overall domestic market performance for the quarter ending March 2025.
It started off pretty volatile, likely influenced by those global uncertainties we mentioned. A strong rebound in March itself. The main indices like the Nifty 50, the Nifty Small Cap 250, the Mid Cap 150 all posted pretty solid gains in March.
Nifty 50 up over 6% in March. Small caps and mid caps even more.
Yes, small cap 250 up 9.1%, mid cap 150 up 7.7% just in March. A strong finish to the quarter.
Although some sectors lagged for the quarter overall.
Right. Looking at the full quarter, sectors like BSE Realty and BSE Information Technology actually ended in the red despite the March bounce.
So that's sectoral variation again. What might have fueled the March rebound? Better domestic news, earnings hopes, FPI flows maybe?
Could be a mix of those. Improved domestic data, maybe expectations of good corporate earnings, and potentially renewed interest from foreign investors could all have played a part.
Okay, let's move to fixed income now. Big news from the RBI in April 2025.
Yes, a significant move. They cut the policy repo rate down to 6%,
And change the stance.
changed the stance to accommodative, signaling they're leaning towards supporting growth, perhaps expecting inflation to stay manageable.
And that flowed through to market rates.
It did. We saw a downward trend in yields, including the key 10-year benchmark government bond yield. Other rates like the reverse repo or SDF, MSF also reflected this easing bias.
What do lower rates generally mean for the economy?
Cheaper borrowing costs for businesses looking to invest, potentially cheaper loans for consumers. Generally aims to stimulate economic activity, makes existing bonds more valuable too, but new fixed income investment less attractive perhaps.
Looking inside the bond market itself, the different segments, government securities, GSECs, still dominate.
They do, naturally, as they represent government borrowing. But the interesting trend is the rise in the share of corporate bonds over the longer term, say from FY11 to FY25.
So companies issuing more long-term debt through bonds.
Seems that way. The corporate bond market appears to be deepening, providing another avenue for companies to raise funds beyond bank loans or equity.
And what about commercial paper, CPs?
Their share seems to have declined somewhat over that period. CPs are short-term debt, so maybe companies shifted towards longer-term funding, or maybe liquidity conditions or regulations influence that.
We also saw a note about rising private placements of corporate bonds.
Yes, suggesting more bonds are being placed directly with large investors rather than through public issues.
Okay. And liquidity in the banking system. Had it been tight?
It seems the liquidity was a bit tight earlier, but moderated in March 2025, partly thanks to RBI actions like liquidity injections.
Right. And finally, the yield curve. What happened there in March?
The entire yield curve shifted downwards, meaning yields across different maturities from short-term to long-term decreased.
And the 10-year benchmark yield came down. Why?
Partly due to those RBI measures and the accommodative stance, for sure. But another major factor mentioned is India's inclusion in global bond indices.
Ah, yes, that's a big deal, isn't it? How does that help?
It really opens the door for large global investment funds, which track these indices, to buy Indian government bonds. This increased demand from foreign portfolio investors, FPIs, pushes prices up and yields down.
So it helps lower borrowing costs for the government and brings in foreign capital?
Exactly. And it helps deepen and integrate the Indian bond market globally.
Okay, fascinating. Lastly, let's touch on a few miscellaneous but really important trends shaping India. Internet adoption. The numbers are staggering.
Absolutely phenomenal growth. Nearly tripled between March 2016 and March 2024.
Reaching how many subscribers?
954 million by March 2024. And the density, subscribers per 100 people, also climbing steadily.
And people aren't just browsing, are they? They're using it for business.
Increasingly so. The data shows a rising percentage in both rural and urban areas using the internet for entrepreneurial purposes between 2022-23 and 2023-24.
And for financial activities.
Very high usage there too.
Yeah.
Internet banking, digital payments,
Yeah.
becoming commonplace for a large chunk of internet users in 2023-24.
This whole digital transformation seems foundational.
It really is. It's enabling new business models, improving financial inclusion, boosting efficiency. It's reshaping the economy.
We also see that reflected in things like mutual fund transactions.
Yes, a very high and growing percentage of both lump sum MF purchases and SECMIAs happening through digital channels.
Yeah.
Huge shift toward digital.
And the phones people use?
Clear trend there too. Rising smartphone adoption, declining use of basic feature phones, again, enabling more digital activity.
And one final point, inward remittances. Money sent home by Indians abroad.
Those remain very significant. A major source of foreign exchange for India, with strong figures noted over the last few years, shows the continued global connection of the Indian diaspora.
Okay, so quite a landscape we've covered. If we try to boil it down to key takeaways, what stands out most to you?
For me, it's India's relative strength, the growth projections, that zero recession probability set against a more challenging global backdrop. That's quite compelling.
Yeah, I agree. Also, the evolving nature of trade with services gaining ground, that feels important for India's future.
Hmm.
And internally, the dynamism within sectors manufacturing showing recovery but also variation, the changing export mix, the shifts in equity and fixed income markets driven by tech and policy.
And underpinning so much of it, that massive digital adoption wave.
Absolutely, that digital transformation is a powerful undercurrent driving change across the board.
So India seems positioned with strong domestic drivers, but also increasing integration into global financial markets,
Yeah.
like with the bond indices.
Exactly. Which brings us to a final thought, perhaps.
Yeah, something for you, the listener, to think about. Given these strong domestic indicators and this rising global integration, how might India navigate future global economic shifts? If there are policy changes in major economies or unexpected global shocks.
Right. What new opportunities might that integration bring? But also, what new challenges could arise for maintaining India's growth path? How do those domestic strengths and global linkages interact going forward?
Definitely food for thought. The complex interplay. Well, thanks for diving deep with us today.